You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, we're taping Options Playbook Radio. It is a Wednesday. The markets are closed. It is May 19th. It's been a little bit of a schizophrenic day. We had the markets down big on the open, and then we had the markets rally going into the close today. A lot of news, I guess, a lot of concerns about inflation. The Fed went and spoke a little bit about things overall. The Dow Jones Industrial Average only ended up down about 0.5%. And the S&P 500 index was even less than that, only about 0.25%. The VIX is elevated, though, and this little spike down really drove the VIX higher. We're seeing at 22.18. It was up about 84 cents, but above the magic 20% level, which we've been talking about for a long time on Options Playbook Radio and just in general in Options Insider Radio. We see the August future now pushing 20. You look at the VIX future contract that follows the VIX options that expire in August, and that's trading at 24.82. So that's breaching that 25% level where a lot of the longer term futures have been trading at. They finally broke down. Now we're going back up looking at it. So even though the market had a strong rally into the close, we're still seeing concerns about inflation overall and just in general what's going on with the economy. So with that said, let's look at last week's trade. Last week's trade, we went back to the old earnings skip strike butterfly. So we were looking at Airbnb, and we had a lot of interesting companies. They weren't FANG stocks, but last week we taped Options Playbook Radio on a Wednesday. And on Thursday after the close, we had quite a few stocks that were announcing earnings. The one that we looked at was Airbnb, and which was really kind of surprising to go along also with Coinbase. We had done a trade on Coinbase the week earlier that we would have probably just got out of because that worked out, even though we were looking at earnings. But it worked out before the earnings announcement. They announced too. Well, neither of the stocks really did anything. A little bit of a spike up after hours, a little bit of a spike down, spike up on the open, back down going into the close, and really just did much of nothing. So Airbnb, the stock was at 140. It was down 2.5 points on the day. And we looked at doing a skip strike about the expected move away on the upside. We were bullish in general, but we're doing it for a net credit, so you'd say neutral to bullish. We went out and bought the one 55 strike call, sold 2 of the 160s, and then bought 1 of the 170s. Airbnb was trading right at 140. We did it for a net credit of 10 cents to the account. Not a big deal. Would have been nicer to get a little bit bigger credit. Maybe you could have if you would have waited until the open the next day overall. But that was the concept, and that's what we always talk about. We're just trying to learn on Options Playbook Radio. Nothing's ever meant to be a recommendation overall. And if we look at the chart on Airbnb, we see that you wouldn't even know that. You'd have to know that they announced earnings because the stock just basically did nothing. On the next day, the market actually, the high for the day was 142. The low was 137 and some change, and it closed at 141. Now, the day before that, it actually made a bigger move to the downside. It was down 2.5 points on the close the day before they announced earnings, or the day of. I guess it would have been the day before. So it made a bigger move on that day than it actually did after the earnings announcement. So that trade would have expired worthless. It continued to go down the next couple of days. You would have made your 10 cents. You would have moved on and said, oh, ho-hum, let's go look for another trade. So same thing kind of happened with Coin, a little bit more volatility in it, but it was a first announcement on their after becoming a publicly traded company. And I even mentioned on the show that I was really surprised. I think the implied volatilities, looking at a 30-day vol, were right around 60% implied volatility. And I kind of mentioned that's where like Tesla normally trades. So we were expecting more volatility as opposed to less volatility. And surprisingly to me, we didn't get it. We didn't get the volatility. We got a big gap up on the open, not a big gap, I think 15 points or so. And, the stock is a fairly expensive stock. So on a percentage basis, it was next to nothing. And then we had, and then it came down, started trading that flat. And I think by the end of the day, it was actually down on that earnings report. And it was a good earnings report and a good forecast. So with that said, that seems to be the theme nowadays. So today, Coinbase has a lot of news. Elon Musk likes to play with it a little bit as far as crypto. But right now, the fact that the company is blowing the doors off earnings-wise and growth-wise doesn't seem to matter anything to the market. All that really matters is the price of Bitcoin. Elon Musk has came out and said, okay, we said that you could buy a Tesla with Bitcoin. Now we're going to take that back because we're worried about the environmental concerns of Bitcoin mining, which is a real deep concept as to why this takes so much energy to create a Bitcoin, but it does overall. And because of that, they no longer want to embrace Bitcoin as a currency to buy Teslas. Stock ran down. China came out today and has done this a couple of times with cryptos in general, but just made some disparaging statements about crypto, and all the cryptos got beaten up. Bitcoin actually did better than most, only because it's probably a little bit better, more well known. But China has done this before and hasn't really followed through with new litigation or just basically saying that you can never buy anything in China with Bitcoin. They've fallen short of that a couple of times, and so a lot of those cryptos did rally into the close, but they were a little bit beaten up. And guess what? Coin was beaten up too. So Coin actually was down that same 15 points that we mentioned, that it kind of ran up on the open after earnings. It was down today $14.20. That's pretty close to about 6%. Last trade was $224.80. But during the IPO, the target price for valuation, or it was a direct IPO, so I don't actually know the vernacular, but they were anticipating it would open around 250, and it opened pretty close to 400. 380, I think, was opening trade, ran to 430. So very interesting stock since the beginning, but now it's below, if you will, the targeted price of 250, down at 224.80, and we'll call it 225. It's easier to say. So 225 approximately if we were to round up. So let's do it again. Let's do a rinse and repeat. So interesting enough, vols have increased more on this 5% down move that we had today than they did around the earnings anticipation. That's a little bit of a head scratcher right there. But we're going to stick with 30-day options and look for more volatility as opposed to less. And we're going to still lean to the upside here. It just kind of, it's a little bit easier to put together this type of trade to the upside. We're going to actually look at a back spread, otherwise known as a volatility spread, sometimes known as a pay later call. The concept is that we're going to sell an expensive call option and use that credit to pay for two less expensive call options. All right. So by doing that, you can phrase this any way that you want to, but really what you're doing is you're selling a credit spread and bringing in enough of a credit to buy an extra call. So you want the market to skyrocket to the upside. You're going to lose on the call credit spread, but you're going to be long an extra option contract. And if the market really skyrockets, obviously that extra contract has unlimited potential. But if the market does go down, you're doing this for a net credit to the account. So if it goes the other direction and makes a strong move to the downside, you can just keep the net credit. So we're not doing it around earnings, and that kind of helps lay out the strategy. Around earnings, it would be hard to go out any time and get something done for a decent credit. We're looking for news. If you don't think that over the next 30 days there's going to be another blindsiding headline with cryptocurrency, then I wouldn't do the trade, because if it just does its normal, what it's been doing since its IPO on a daily basis, then the underlying stock will kind of be boring. I mean, anticipated, but I anticipate news. And when we looked at strategies like this, we even talked about a long straddle back in the day on Boeing. And obviously those turned out to be really good trades overall. But that was the thing about Boeing, is it was trading at a normal volatility, and you knew that over any 30-day period, there pretty good guess that there were going to be some major headlines that were going to be coming out on Boeing. Will the plane fly? When it flies, how many will they let fly? How long will it take for the airlines to put them back in stock? Are there any other airlines that are ordering these planes that they're having issues with the MAX? So that one was a little bit of a no-brainer. I'm anticipating that something could happen like that with coin. And if you don't think that, then you wouldn't do this trade, right? Because you need some news to spark it, to generate the type of volatility that we need in either direction. And it can't just be chop volatility. It's got to either, go skyrocketing to the upside or to the downside. So we're going to lean bullish. We're going to try to catch a falling knife here with coin being at 224.80 right now. We're going to go to that June expiration. And I'm going to skew it a little differently than I would if it was around earnings. I'm going to actually sell the 2010 call. So that's 14 points in the money, a little bit of juice in it. That's trading at 80% vol, like I said, which was higher than the vol was around earnings on a 30-day option. That's trading right now around $28. And we're going to sell that option contract to buy a couple just out of the money option contracts. We're going to buy the 250 strike call. We're going to buy two of them. They're trading for around $11, approximately, around the midpoint. And we're going to get this entire trade done. It's going to be a 40-point wide spread, which means we really wanted to move 40 points in some direction, ultimately. Usually when you put on a back spread, you're anticipating the move to be at least that 40 points. But we're going to get this done for a large net credit of $6.15. So if we're wrong and it goes below 210, I want to be able to make something on this. That's ultimately what we're looking at. So from 210 and beyond, if it goes down to 190, 180, all the options would expire worthless, and we would make that $6.15 credit. On the upside, as I mentioned, we just needed to go beyond 250 and continue on up. the sooner the better. Time decay is not our friend because we are long to option contracts that are a little bit out of the money. So they're going to be very susceptible to time decay. The only way that we could lose the maximum on this trade, which would be the width of the spread, 40 points, minus actually the 615. It's enough of a credit to mention it. So $40. So the worst case scenario would be you could, if it went out right at expiration, June 18th, right at 250, you would lose $40 in theory, right? You're not worried about commissions and everything here. $40 minus $6.15, which is the midpoint, or $33.85 for every 1x2 spread you put on. And so if I'm buying a $33 option and it is a ratio spread, that means for every one that we do, we could lose $3,385. That's for every spread that we put on. So we're just talking about it on a 1x2 basis. But if you were going to do 2 spreads, that would be a 2x4, or if you did 3, a 3x6. And that's how you would enter the trade. It would all go down at a net credit to the account based off of the ratio and how that gets quoted with the option contracts, et cetera, et cetera. Okay, lowest common denominator. We got a couple other little fun things that are in there. But $6.15. So we can make money to the downside. We make money to the upside. Obviously, we make money quicker to the downside. Well, we need time decay to hit us. If it just goes down to 210, we still need that $28 option contract that we're selling to decay. So we do need to be closer to the expiration to get it on the downside. But with the underlying stock trading right now at 222, well, let's call it 225, right? 210 is only 15 points away. It made a 15-point move today by itself. On the upside, though, if it gets to 250 tomorrow, if it were to move the 25 points to the upside tomorrow, well, this trade would definitely be profitable. But that is the valley of death. That's where time decay kind of hurts us. So from that point, we really want it to rock. And you'd anticipate going to 270, 275. That's the type of profit or type of upside that we're looking for. So you'd be putting this on for a net credit of $6.15. And hopefully you're going to be closing it, for lack of a better way of saying it, because we're going to close it also for a net credit. So are you selling it to open and selling it to close, right? So ultimately, you would close this trade. And if you are correct on your forecast and it gets to 270 or 275, well, then you're going to also be selling this thing for a net credit to the account when you get out. And it is unlimited as to what it could be on the upside. Now, you're going to battle. You're going to battle that loss of that short call spread. So you really would like it to go to 290, 300 if you're going to stay all the way to expiration. But this trade, you're going to get out of this trade within a week or two. You're not going to be in it the last 2 weeks to expiration, because that's not what the trade is about. Time decay is not on your side. You want to see if we get this bounce back, if we get some major news over the next couple of weeks, and if not, then you don't want to do the trade. So let's recap it and then call it a day here on Options Playbook Radio. We're looking to go to the June 18th expiration. We're going to sell the 2010 call option. And at the same time, we're going to buy 2 of the 2050 call options. We're going to do this at a net credit to the account, if we could fill it to midpoint, of $6.15. And our max risk would be $33.85 overall on a 1x2 basis. That's $3,385 plus commission to put on that trade. The only way you lose that is if it goes right at 250, right at the expiration date of June 18th. And that's it for this episode of Options Playbook Radio. If you have a question you'd like to send me, you can send it directly to me if you want at theoptionsguy@invest.ally.com. Please follow me at Twitter. I tweet about not only Options Playbook Radio, but a lot of the educational events that we have over at Ally Invest. So an easy way to find out about them is just to follow me on Twitter. It's at Brian Overby, as simple as it gets. And I guess that'll be it for this episode. So thanks for listening, and we'll be back at the same time, same place next week. Till then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.